How do adjusting entries affect the financial statements? In this video, I apply them to a company example and show how items such as interest, prepaid expenses, and depreciation impact both the balance sheet and the income statement. In the first two videos of this Transactions to Financial Statements series, I introduced a hypothetical company, Hartford Hot Sauce, and we went through several transactions which are very much representative of common transactions that firms experience and how they impact their balance sheet and income statement. At the end of those two videos, I said we were able to build a baby balance sheet and income statement that reflects all of those transactions and how we have recorded them, but we haven't yet been able to prepare the final full financial statements because we did not take into account the passage of time. Specifically, we didn't do the adjusting entries that the company must do at the end of the quarter to make sure that there are no revenues or expenses missing from the income statement and all of their assets and liabilities on the balance sheet are accurately reflected at the end of the quarter. Now we're going to bring this example home, and for Hartford Hot Sauce, we're going to do some adjusting entries, which are very representative of the adjusting entries that real companies must do at the end of the period. Let's assume that this loan came with interest rate. We borrowed $100,000, and that loan is for 2 years with a 6% annual rate, and we are not paying interest as we go along. The interest is going to accumulate, and we're going to pay it at the end of the 2 years. Now, even though the interest is accumulating and we're not paying it immediately, we still are going to reflect it during this period. Why do we need to reflect an interest expense if we're not paying cash? Because this loan is helping us to run our business today. So the cost of debt, the interest associated with this loan, it's not only reserved for something that's going to happen 2 years from now, it is helping us to operate right now. So we're going to spread out the cost of this loan over the 2 years that it is outstanding. 1 quarter has passed since we have borrowed the money. So the interest expense is the annual 6% divided by 4 times the principal amount of $100,000. Interest expense is $1,500. How does this interest expense impact our financial statement? Well, it shows up as an expense on the income statement. Don't forget, any expense is a profit decreasing item. So the profit is reduced by $1,500. Next step, we have a mechanical link. We remember that anytime we have earnings reduced, that means the retained earnings are reduced as well. So we have an equity account called retained earnings gets reduced. And what else happens? Well, we're not paying cash right now, but we do have a liability to pay cash associated with this interest in the future. So we're going to create an interest payable. Don't forget, the way that we present how the transactions connect to the financial statements doesn't show us the running balance of the accounts. This only shows an impact of this particular transaction on the financial statements of this period. So having interest led to the creation of an interest expense, it reduced our retained earnings, and it increased the liability called interest payable. Now, what about $100,000? What about the full balance of the principal? Don't worry about it. Don't forget, we have correctly recorded it as a liability of $100,000. It's not changing. Here, we're only recognizing the cost of debt, which needs to be recognized with an adjusting entry. Let's talk about the prepaid to the advertising agency now. We paid $12,000 for 1 year of service from December 2019 through November of 2020. Now we are closing the books on December 31st. So we ask ourselves, how much of that asset have we already used up? We have already received 1 month of advertising. So we no longer have 12 months remaining. We have used up 1 month and only have 11 months remaining. So 1 month of advertising needs to be recognized. We're going to recognize advertising expense of $1,000. We could put it together in selling, general, and administrative. We could keep it separate. It doesn't really matter. Our profit goes down. Correspondingly, the retained earnings goes down. And what happens on the asset side? We're not paying the cash because we have already paid cash previously. We paid cash and created an asset called prepaid expense. Now we're just using this asset up smoothly over the period. Prepaid expense goes down by $1,000. Let's introduce the concept of depreciation. Whenever a company purchases a long-lived tangible asset, let's suppose that they purchase it with cash, but it doesn't really matter. They have a cash account go down and they have an asset account go up. Notice that we don't recognize an expense here. When we acquire this asset, don't use it up on the same day, within the same week. This is something that we're going to use up over multiple periods in the future. So it makes sense that we want to spread the cost of this asset over multiple periods in the future as well. As we use this asset up, we're going to recognize the expense associated with that, and we're going to call it depreciation. Depreciation is going to be an adjusting entry that we do that reflects the usage of long-lived assets over time. Hartford Hot Sauce bought a truck for $90,000. We need to think about how long this truck is going to be useful to us and what are we going to do with this truck at the end. Is it going to be junk or are we going to be able to sell it? They're going to assume that the truck is going to be used for 30 years and at that time it will be sold for $30,000. We have a cost of truck which is now going to be spread over time. We're not going to depreciate the $30,000 because we expect to get it on the tail end. So we're going to say our cost is $90,000, but we're going to subtract what we expect to get at the end, $30,000. We really only need to spread the $60,000 over 30 years because that's our expected usage. And that leads to $2,000. But we're also doing this adjusting entries quarterly because we're preparing our financial statements quarterly. So the expense is going to be $500 every quarter. So we have here depreciation expense that reduces our profits. Correspondingly, that reduces our retained earnings. And on the asset side, for now, I'm going to say that that reduces the asset itself. So here I have a reduction to net PP&E of $500. I will mention that this is a simplification, and in the long-lived asset videos, I will talk about the specific details of how that's recorded. And in those videos, I will also talk about the fact that what happens when these assumptions are wrong. But for now, let's only worry about the assumptions as they make them with the best available information at the time that they're preparing their first financial statements. Let's do a last adjusting entry relating to taxes. Again, for simplicity, let's assume that they can estimate precisely their corporate income tax bill. And let's say it's going to be $800 and they expect to pay it in April of next year. They are going to recognize a tax expense. Again, even though the transaction that's related to cash is coming in the future, but they know that this cash payment in the future is generated by the activity that they're engaging with in this quarter. So it's appropriate that the tax expense is also recognized right now. That is a profit reducing item. It also reduces the retained earnings, and we create a liability called tax payable. The last transaction is not an adjusting entry, but I want to throw it in there as an example just to round things off. Let's suppose that this company is really unusual and they say, even though we've only been in operations for one quarter, we're going to pay ourselves dividends. So on the last day of December, the firm declares dividends of $900 that they will pay to the three owners in January of 2020. First of all, do they report anything on the income statement? Absolutely not. Dividends are not an expense. They do not show up on the income statement. They're not part of the cost of running your business. So we don't see anything changing on the income statement, but we do see a reduction to the retained earnings, and correspondingly, we have an account dividends payable that increases. If these dividends were paid in cash immediately, we would simply have the cash that would be going down. Technically, there is a separate dividend account that gets rolled into the retained earnings, but for simplicity, it is completely fine for us to think about dividends as simply reducing the retained earnings at the point when they are declared. Now that we have accounted for all of the obvious transactions that happen in the normal course of business in the prior videos, and in this video, we have accounted for the adjusting entries that Hartford Hot Sauce had to do to make sure that nothing is missing from their financial statements. All of the accounts now have correct ending balances, and we could use the information from those accounts to build the income statement and the balance sheet. So income statement gets created first. We have revenues, we have cost of goods sold, gross profit, which is just revenues minus cost of goods sold without taking into account any other expenses. We have operating expenses, SG&A, marketing research, two adjusting entries that led to expenses during this video, which is advertising and depreciation expense. This company has an operating loss. So here, kind of the labeling, we can easily see if it's a positive number, it's an operating profit. If it's a negative number, it's an operating loss. They have interest expenses and tax expenses we have added, but they do have one non-recurring transaction, which is a gain on a recipe sale that we covered in the prior Video. As Hartford Hot Sauce prepared the income statement, I made sure that they have consistency in terms of the signs of the numbers. In the introductory video to the income statement, I talked to you about the fact that a lot of companies, such as Johnson & Johnson, show all of the expenses as positive numbers. So that means if they have any items on the income statement which are actually profit increasing, they're going to show it as a negative number. So that's why the gain on the sale shows up as a negative number here, because unlike an expense, it is a profit increasing line item. We have a net profit of $8,200. The reason we prepare the income statement first is because it actually helps us to prepare the balance sheet, because the retained earnings go up by exactly the amount that we have in the net earnings on the income statement. So this 8,200 is going to go to the retained earnings. And because our retained earnings started at zero, they went up by the amount of the net income. Then they were decreased by the dividends declared, and they have an ending balance of 7,300. After we've accounted for all of the transactions that happened during the quarter, for all of the adjusting entries, now we can be sure that the ending balances of all of our assets, liabilities account are accurate. Now the balance sheet is ready and it is complete. This wraps up our transactions to financial statement series. The next videos will cover more detail of specific accounts, issues with revenue recognition, inventory accounting, debt, equity. We have a variety of topics which are disclosed to us in financial reporting, which are interesting and relevant. Watch out for Footnote Friday episodes where I will look at current events, news articles, and deep dives into 10K. If you enjoyed this video, then please like, subscribe, share it with your colleagues and friends, and I'll see you in the next one.